So welcome everybody. The purpose of this little mini lecture is to review the solutions for exam number 3. At this point, all your exams have been graded. I've posted all the grades on Blackboard, and I have also posted the final grades on the with the registrar. As I explained in the little cover note that I sent out to you, telling you about this video, the grades that I assign are in accordance with the syllabus, which we had distributed at the beginning of the semester. So here goes. So there were 20 multiple choice questions. Each one was worth 3 points. So the maximum you could have got on this one, there were 20 questions. So you could have got 60 points if you got all the multiple choice questions correct. A couple of you got real close to that. And then each one of the short little problems were worth 10 points each. So let's go through and discuss each one. So a company purchased land for, it's a multiple choice first, a company purchased land for $90,000 cash. Real estate broker's commission was $5,000, and $7,000 was spent for demolishing the old building on the land before the construction of a new building. Under the historical cost principle, pay no attention to that one. Under the historical cost principle, the asset is worth, cost of the asset is all the cost necessary to get the asset installed for the purpose I purchased it for. So you add the 90,000 to the 5 to the 7, that gives you 102. So the answer to number 1 is D. 2, which of the following assets does not decline in service potential over its useful life? Well, equipment, furnishings, fixtures, these are all things that are depreciated. Land, it is not depreciated. So we don't depreciate land, it doesn't lose its value. Number 3, a factor that is not relevant in computing depreciation. Well, all the different methods of depreciation consider cost, salvage value, and useful life. They do not consider the replacement value. So the one that is not relevant there is A. Number 4, useful life is expressed in terms of use expected from the asset. Well, use, that could be in hours, that could be in units. So declining balance and straight line do it on the basis of the number of years. The units of activity basis it's on the actual usage, whether that be measured. You come up with a rate per hour, a rate per mile, rate per unit. So that's it's the unit of activity method, which we use like on pieces of like an automobile or a jet engine. Also, we use unit of activity for depletion as well, which may show up later on. Number 5, a gain or loss on disposal of a planned asset is determined by comparing the book value to the proceeds. So if you get more than the proceeds are larger than the book value, you've got a gain. And the proceeds are less than the book value, you've got a loss. So the answer there is D. 6, the method most commonly used to compute depletion is the units of activity, which we had mentioned earlier. So depletion, again, that's for oil in the ground, trees in the forest, diamonds in the ground, so forth. We use units of activity for that to get the depletion. So depletion is how we recover the cost of a natural resource. Number 7, during 2021, the Rathke Corporation reported net sales of $3 million, net income of 1.2, depreciation of 100. So there's a whole bunch of stuff in here you don't need. They also reported beginning assets of 1 million and ending assets of 1.5 million. They told us what the plant's assets were, and they told us what the accumulated depreciation was. And they want to know what the asset turnover is. So the asset turnover is simply the net sales divided by the average total assets. So that would be 3 million divided by the average of 1 million and 1,500,000, which I think is 1,250,000. So if you divide 3 million by 1,250,000, you come up with 2.4. So your answer there is B. 8, natural resources are generally shown on the balance sheet. Natural resources show up in the property, plant, and equipment. They're not intangible. They do have tangible things like copyrights, patents, and goodwill. Investments would be we own stock or we own securities in other companies. Owner's equity, we know what that is. Natural resources show up as part of property, plant, and equipment. So the answer there is C. Number 9, under the corporate form of organization, the only answer that is correct there is C. The corporation's life is stipulated in the charter. These other things are just not true there. The stockholder is not personally liable. A stockholder cannot bind the corporation if they haven't been appointed as agents of the corporation. And D, stockholders wishing to sell their shares must get the approval. That none of those things are true. The only one that is true is C. So the corporate charter is what they get from the state that gives them the right to carry on business like an individual. Number 10, stockholders of a corporation, they elect the board of directors. They don't vote. The president of the company, the treasurer, the employees, the key employees would be hired by the board of directors. So the stockholders don't vote for them directly. They basically vote for the board of directors. So the answer there is B. 11, preferred stockholders have priority over common stockholders. They have preference over dividends and claims in the assets in the event of liquidation. Those are the two things that make them preferred over the common stock. 12, the purchase of treasury stock. So what does the treasury stock do? Well, in the corporate charter, they'll tell you how many shares the company is allowed to sell. On the balance sheet, they'll tell you how many of those shares that they were authorized to sell did they actually sell. Those would be the shares issued. The number of shares outstanding are those shares that are currently held by stockholders. So when you buy treasury stock, essentially what you do is you buy back some of that stock that's outstanding. You buy back and the company holds on to it. So the answer to 12 is that a purchase of treasury stock would decrease the common shares outstanding. 13, Rubio Corporation began business by issuing 300,000 shares of $5 par stock for $25 a share. During its first year, the corporation sustained a loss of $50,000. So again, we're given information that we don't need here. And so when they sell the shares, the amount of paid-in capital they're going to have is 300,000 shares times 25,000. They'll throw 300,000 shares times $5. It was the par value, and $25 was the amount that they sold for. So they're going to get $7,500,000 worth of cash. So if you think of the full transaction, would be a debit to cash of $7,500,000. The credit to common stock would be 300,000 times $5 a share, which would be 1,500,000. And the difference between them would be additional paid-in capital. So of the available choices there, the only one that is correct, it says during its year, the corporation, the year-end balance sheet would show common stock of 1,500,000. So yes, you did receive 7,500,000, but you needed to allocate that between the common stock and the paid-in capital in excess of par value. So the correct answer there for 13 is A. 14, paid-in capital from treasury stock would appear on the balance sheet as additional paid-in capital. So you remember, a company can't recognize gain or loss on the purchase or sale of its own securities. So if they have treasury stock and they bought it at 100 and they resold it at 125, that $25 is not a gain. It becomes additional paid-in capital from sale of treasury stock. 15, the disposal of a significant component of a business, that's called discontinued operations. So the answer there is D. 16, which of the following would be considered an other comprehensive net income, other comprehensive income? So remember, other comprehensive income is the items of revenue and expenses that don't flow through the income statement. And the only one that would be the example of this on the list there would be unrealized loss on available for sale securities. So we recognize either the gain or loss on the securities, but it doesn't flow through the income statement. It becomes part of what we call other comprehensive income. So the answer there is D. 17, which of the following is not a tool in financial statement analysis? So we do in financial statement analysis, we do horizontal analysis, we do vertical analysis, we do ratio analysis. We don't do B, circular analysis. So the answer there is B. They were looking for which of the following is not a tool in financial analysis. 18, so they gave us this company. They had the following information. They want us to use vertical analysis. What is the percentage of net income? So under vertical analysis, you take the 75 net income and you divide by the 300 net sales and you get 25%. This one here is very similar to one of the problems that we're going to get to later on. When you do vertical analysis, you take every item on the income statement and you express it as a percentage of net sales. So if you did the full statement here, you take 180 divided by 300 would give you the percentage of cost of goods sold. 120 divided by 300 would give you the percentage for gross profit. 45 by 300 would give you the percentage of operating expenses. But the question says, what is the percentage of net income? on the vertical analysis. So 75 divided by 300 gives you 25%. 19, which of the following is not a characteristic generally evaluated analyzing financial statement using ratio analysis? So the ratio analysis fell into three groups. So we had ratios to compute liquidity, those to compute profitability, those to compute solvency. We did not have a category called marketability. And the last one, the liquidity, a liquidity ratio is basically measures the ability of the company to pay its bills when they come due, and any unexpected needs, be prepared for any unexpected needs for cash. So the answer there for 20 is C. All right, that's the multiple choice. And again, 20 questions, maximum 3 points each. So the maximum you could have got there was 60 points. And then each of these short little problems was worth 10. So we purchased a machine that cost $80,000. It has expected to have a $5,000 salvage value at the end of the 5-year useful life. So we've got a cost of 80, we've got a salvage value of 5, and we've got a useful life of 5 years. So we want the depreciation during the first and second year. So on the straight line method, each year, it would simply be the 80,000 cost minus the salvage value of 5 divided by 5. So you're going to get 15,000 the first year, you're going to get 15,000 the second year. Next year, what's called double declining balance. So we use twice the straight line rate. So if it's a useful life of 5 years, 100% divided by 5 is 20%. So what we do for double declining balance, we use 40%. And what's called declining balance because we take the full cost of the asset minus any depreciation taken in previous years. So we don't consider the salvage value in the initial computation. We're mindful of the salvage value because the book value under this method can never go below the salvage value. But for the first year on the double declining balance, it would be 80,000 times 40%, which gives me 32,000. And in the second year, we still use double, i.e. the 40%, but it's declining balance. So the depreciation the second year is the 80,000 minus the depreciation that we took in the first year. And you multiply that out and you get 19,200. Okay, issuance of stock here. So it's both in common stock, and the rule is when you issue common stock, you record, if it's given for cash, it's pretty straightforward. The amount that you assign to the common stock and the paid in capital is determined by the amount of cash you receive. But if you give the asset, if you give stock for another asset other than cash, you base it on either the fair market value of the asset or the fair market value of the stock, whichever is more readily determinable. So let's look at the first one here. Issued 2,000 shares of $10 par stock for $20 a share. So 2,000 times 20, that's where I get my $40,000 worth of cash. The stock had a par value of $10 a share. So 2,000 times 10 gives me 20,000. How do I account for the difference? That's paid in capital in excess of par. B, issued 5,000 shares of stock for land advertised for sale at 90. And their stock is currently actively traded at $16 per share. So in this case, it's the advertised value of the land. You don't know what the people always advertise it. That's the price that they want. So in this real estate market, you may end up paying more for the land than the actual advertised price. So the advertised price really isn't all that relevant when you compare it to the market value of the stock, which is readily determined at $16 a share. The fact that the stock is actively traded at $16 a share, the cost of the land is 5,000 shares times 16, which gives you the 80,000. Common stock in this case still has the $10 par, so 5,000 times 10 gives you 50,000. And the difference is paid in capital in excess of par. The third one here, and this one was very simple, although some of you got some strange numbers here. So in vertical analysis, if you do the income statement, everything is expressed as a percentage of sales. If you do the balance sheet, everything is expressed as a percentage of total assets. So here it was just the income statement, vertical analysis on the income statement. So everything divided by net sales, which is 500,000. So 500,000 divided by 500,000 gives you 100%. Cost of goods sold, 310 divided by 50 gives you 62%. Gross profit 190 divided by 50, 500,000 gives you 38%. Operating expenses 120 divided by 300,000 gives you 24%. And net income 70,000 divided by 150,000 gives you 14%. And the last one, we just had to compute some basic ratios. So Noble had net income 175 and net sales of 625. Company's total assets averaged, they made this simple for us. They told us they averaged out the assets for us, and they were $4 million. Its common stockholders' equity for the period averaged $2,340,000. Calculate gross profit margin, return on assets, and return on stockholders' equity. So profit margin would be just net income divided by sales. So there's your net income, there's your sales. So you get 600 and net sales of 625, you get 28%. Return on assets would simply be the net income divided by the average total assets. They made it nice and simple for us. They told us what the average total assets were. They were 400,000. So that's where I got 4.4%. And return on stockholders' equity normally is net income minus preferred dividends divided by the average number of shares outstanding. You didn't have any mention of preferred dividends, so it's simply 175,000 divided by the number of shares outstanding, which they told you was $2,340,000. I'm sorry, the not shares outstanding, the total stockholders' equity. So return on stockholders' equity, net income minus preferred dividend divided by the total common stockholders' equity, which was given. Again, there is no preferred dividend, so your answer there is 7.5%. Okay, so I hope you found that this review interesting and useful. And I've enjoyed having you in class this semester. Good luck to you. Some of you did real well in the final. And I hope all of you got something out of the course. A couple of you didn't make it. I hope you learn from the experience. Oftentimes it's said greatness is measured in not never falling, but getting up each time that we fall. So if you did well, that's great. Keep up the good work. If you didn't do as well as you could, this is a good time to reflect. You would have liked to. This is a good time to reflect and say, next time I take an accounting course, next time I take any course, what lessons can I learn here that I can apply in future? I think John gave a very impassioned, shared his experience after the first exam, how his study habits and his preparation for exams and homework was very different the first time he went to school than when he got a little bit of work experience and came back. So either way, I enjoyed having you. Good luck to you all in your future careers, and hope to see you all again. Be well, everybody. Have a great day.